Hey guys, and welcome back here on Alpha Trading. Today we're going to talk about liquidity and smart money, and I will show you the most common smart money traps when it comes to future trading. So first of all, we have the higher high and the lower low fake, the double bottom and the double high, also the stop fishing, and I will also go on to show you the characteristics and the logical aspects so that you know really everything about this setup and you can trade it also in the future to generate payouts. So let's start with the first step and with our first trap, and it would be the higher high and lower low fake, and I will show you exactly how to trade it, how to manage it, and where to put your target and stop loss. So first of all, we have to identify our trap, and if you look at this example right here, you will see that we have a bias which is long. So we have an uptrend, and the uptrend indicates that we want to go long because we want to buy really cheap to sell then really high. So if we look at this example, we will see that the structure is long, the bias is long, and also we always want to create when we are long a higher high. So as you can see in our example, every high then gets broken and our target should always be to build a newer high. Also, all the lows that were created then become a resistance zone, so every low is a resistance because we are in a long trend. Otherwise, if we are in a short trend, the highs would be a resistance and the lows would be our support, but our target, because the probability would be much higher to break the low than the high because we are in a short trend. So in this example, the odds of breaking a high or a low are better for breaking the high, but we have here our higher high, lower low fake. So if you see this example in your chart, always be sure to position yourself still in the long, because we have here the most common trap nowadays, which generates liquidity in very cheap prices. So as you know, if we position ourselves long here and we don't go out and take our profit over the top, our position is still active, so our stop loss would have been here, because we always want, or retail traders always put their stop loss under the wick and always under the swing that was created. So if you look up to this is our swing structure, and logically all the stop losses were positioned down here. So the market then goes up and forms a new high, and this is a trap. So the market forms a new high, and as you can see, we traded the highest price, the most expensive price of the day over here, and from there, only from there, the market then goes down. If the market does a move like this, but not from the highest price of the day, then it's not the trap, then you have to be really careful. So always be sure to only trade this trap if the market does it from the most expensive or highest price of the day. So then the market hunts liquidity, because our liquidity is down here because all of the stop losses. And what you can see is that here it filled some stops, but then on the next move all the other stops got filled. So every retail trader who positioned himself here long got stopped out. So liquidity was generated, and in a very short time much volume could be generated, and so institutions could position themselves very cheap and very fast with the big positions down here. Also what you can see, and what you should want to see, is that then the structure really changes and really becomes again a long trend. So here again the structure then goes, if we look up, the structure goes down here, up here, down here, and over this swing. So in this case your entry would be up here, because liquidity in this move was generated down here, and the swing and the structure of the market really changes up here. You can also say, okay, if the market doesn't close under this swing, so if the market doesn't form a new low, I want to see what the order flow tells me. We will look up the details after this scenario, so the logical aspects that I told you, we look this up too. But the most common way to trade the higher high and lower low fake would be to position yourself over this top, over this swing here, to put your stop. One stop could be positioned yourself here, because if we test, or if we trap on the retail traders, this price in the most parts would always be defended, so the market won't go down here again. But you can also put your stop loss here if you have a good risk reward ratio. So in this case, you want to go out some ticks over the top, because also here liquidity is laying here over here, and some stop loss will get triggered, so the market will make a move like this. And as you saw, the market did a move much stronger. So yeah, in this example, your trade should be like this. So you have a really good risk reward ratio and a probability which is very, very high. So it was the first example. Now let's look up in the second one what we can see here. And again, the structure and the logical aspects will always be the same. So you always have to trade and see the market move up to the highest price of the day, and then down under the swing that was created before to get the liquidity, and to then position yourself over the second swing, which I showed you. So in this example, it's not the same situation, but as I told you, the structure will always be the same. Depends how many stop losses and how many structures we are breaking. So in this example, we are not just breaking one swing, but 4 or 3, I think. So yeah, 1, 2, and 3 swings. So as you can see, the market moved up to the highest price of the day and didn't form a double top or something. Yeah, very good high of the day, like a double high or so, or double bottom for the bottoms, which is common for a high. No, this is not a strong high. So as we saw, then the market moved down, targeted the stops 1, stops 2, and stops 3, and generated very much liquidity, because liquidity is laying down here on this road. So as you can see, liquidity was fished, and then what the market does again is that he forms a double bottom or a swing down here again, and then the swing gets broken out. So we go over this swing, and there your long would be opened. So in this example, again, a long, your stop loss would be down here and your target would be up here. I couldn't show you in this example, but as you can see, our or the market did go up after this example, but I couldn't show you. So or did I show you here? No, I don't think so. Could be potentially. I don't know. It was okay. It did go up but the next day. Okay. So in this example, what we can see again is also the higher high and lower low fake. Also higher high in this scenario. Higher high is more common because market did go up in the last few weeks. So these examples are of the last few weeks. So again, we trade the highest price of the day, and then we have a strong movement to the downside, which goes into this liquidity number 1, liquidity number 2 under all the swings, and very much liquidity is generated. And again, what we see here, what we can see here, is that we have the first swing, the second swing, the third swing, and then we just go in over this price. So you really have to be careful. In this example, it's a bit complicated to identify, so more difficult than the other examples. But if you really understand the market, really understand the liquidity, you will always be able to find good trades. So your entry could possibly be here, stop loss could be here or down here. Depends if you have or if you want to have a positive risk reward ratio. Your target, as I told you, should be up here. First of all, we got rejected 2 times. So what we can also do is to do a trading stop loss where we would trail under the lows or under the move. Depends how your trading style really is. But if you wanted to make a fill or kill trade, so you don't move your stop loss and don't move your target or take profit, your trade could be something similar to this. So your position, your entry would be here, stop loss 1 or stop loss 2 and target 1. Even if you say, okay, I want to let the trade develop if he break this high, because oftentimes when we break the high again, the move, as you see, goes really strong on the upside. So yeah, depends if you say I'm fine with getting out here a few ticks over the top, or if you say, okay, I want really to get here a nice move to the upside, so you can adjust your risk reward ratio. So If we see here the double bottom, in this case, double high, double bottom, you see that I traded it also, and that my trade I opened was here. My first target was over the high, then I did a trailing drawdown, and yeah, got stopped out down here. Not really lucky, but sometimes it's like this, so you don't have to be angry or something, it's just the market. So I will now explain you the double bottom and double high and how you can really trade it, because it's really hard and complicated for the most double bottoms and double highs. So the logic first, where the trap is placed, it's not like the liquidity is fished. On the other side, it's that the breakout traders are getting trapped. So we have many trapped sellers or trapped buyers, and they want to trade the breakout, but they don't have the power to come through our zone. So if we look up, we have a short trend, and the low is placed down here, so is built down here, because then the market gets rejected. We see our wick down here, and the market goes up again and formed this high. So you can see really that the market formed the high here because this wick was broken. So then it builds this high, goes down again, forms a new high, but in this case not really a strong low, because if we build a low, we really want to close the candle below the low. So if we have an uptrend or downtrend, always be sure to assure that you see the candle closing above or under the zone you want to trade, to then say, okay, the trend is continuing. So in this example, the candle didn't close under the low, it just formed a wick under, so we stopped out again. And many guys wanted to trade a breakout. Many guys tried to trade the reversal on this candle here, but then got stopped out because their stop losses were put down there or placed down there. And then the trap begins. So we have the trap where we target a stop loss, some of the stop loss, and we don't fill all of them, so liquidity is blocked. We target some of the stops, but not all. We don't fill all the stops, and so the order book is not filled enough, and because of this, the sellers in this case will really panic and buy back their positions because they don't want to get stopped out, and this creates a momentum to the other side. So if we look in this example, I positioned myself right above here, right above this high, so our swings were a bit like this, as I told you, and then we broke this swing here, and in this case I always want to trade from liquidity to liquidity. So as we know, liquidity was laying down here and also was generated here, so we have liquidity laying here, and the big institutions can always just get out from liquidity to other liquidities. So if you look at this example, liquidity is laying over here. So we really want to make this move from liquidity to liquidity. This is why my first target was over the top, but I thought the market would explode a bit more, but then it came to a sideways phase or to a range, and this is why I traded my stop. In this case, a bit unlucky, but I always will show the truth of my trading. So yeah. If you also look at the footprint chart in this example, you can really see that the strong buyers were coming in when I positioned myself. So as you see, this is exactly the example I showed you before. We have the big wick, then we have the sellers which got trapped here. You see the red the red zone in my footprint chart, and then as I told you, the blue zone, which indicates that really the sellers gave up. And in my example, I positioned myself over this volume, so I saw that here many buyers are coming in, and I saw that here not much was going on. Also, we had a bad auction quality up here. If you are interested in learning what a bad auction quality is, you can comment it in the comments, and I will show you. So, as I told you, I want to practice my English. I think I'm becoming a bit better. My accent is really bad. I have to optimize that. But yeah, so I got in my trade here when the buyers came in, and also in this example, like in the example with the higher high or lower low, we always want to put our stop loss under the wicks, under the low or high that was created, because this high is really good. It's not like some other highs where we don't know will it hold or not. In this case, we have really a big institution backing us up, so we really want to put our stop loss down here, because if the market goes down here again, then the probability of that the market will really make the breakout and go down are really high. So our entry was right here, I think on the POC, the POC of the candle, point of control, and the stop loss should be down here. And then our target was up here. First target was up here, I think. So you see really a risk reward ratio just of 1-to-1. I wanted that the trade developed a bit more. My second out was here. So really my position, as I told you, from here to there, but you saw the probability was very high, and I think in those scenarios the probability are over 80%. So a really nice way to trade. Your evaluations combines, get payouts, really appreciate this. So another example here, double bottom followed by another double bottom, which is very common. So first of all, we have a big swing, and oftentimes these moves are created or will be created on the low or on the high of the day. So really, if you want to trade a reversal from the low or the high of the day, this should be really what you are looking for. So first of all, we have our swing, and you see really the structure is changing, because here down here we have again a changement of structure. So this indicates, first of all, this would be an interesting place, and if we really want to trade another reversal, we would have to look here down here and to make our zone a bit like this. So yeah, first of all, if we look at this swing and we look at the double bottom just itself, and we change the time frame from like a 5-minute time frame to maybe a 50-minute time frame, the double bottom would change, because we have three times more candles in the 5-minute chart than in the 15 or 30-minute chart, even 6 times. So our first move was created down here, swing 1, swing 2, swing 4, and swing 4 here in this example. And as you really can see, this is also a double bottom, so would be a double bottom breaking a new structure, W, if we want to call that also. So really this is a good structure. But now the trick how to open your long position before the fourth ring is created, and to really make a good trade, is that you look if we create a smaller double bottom inside the double bottom, and this is exactly what happened here. So we can also call this here the double bottom, but I think this looks a bit better. So you can always have your opinion, you can always enter your trade after scenarios like this, because you will always be profitable then, but sometimes it's a bit more difficult to really see where the real double bottom is created. In my opinion, the real double bottom starts over here, because we again fake the low. So we go under the low but don't fill the order book, so not all stops are fished, not all the liquidity is generated, but this will create the strong move to the upside. And then we have the double bottom down here with this swing down there. So as you learned, we always want to position ourselves if the swing was then broken. So our entry would be here, and our stop loss would be here or here. And always our target, as you know, would be from liquidity to the other liquidity. In this example, we have some fair value gaps over here. So this is a fair value gap. If you don't know what it is, also over this subject, I would and can make a video and how to trade them. But yeah, would be a target. And if we look again to our risk reward ratio, we can see that it's a really good risk reward ratio, and that we have very high probabilities for this scenario. So yeah, double bottom, one of the smart money concept and smart money traps that I really like to trade. Again here, Also, what you can see in the footprint chart, I know that not many of you guys understand the footprint chart, but in Germany it's really common to use it. I don't know why the Americans don't really show it on their live tradings or so, but really helps if you know how to understand the order flow and other tools and other statistics, so you can really position yourself with the big players. So I don't think that this is necessary to explain, but I will try quickly. So we have some strong sellers, as I told you here. The low in this example was again created with very, very high sellers, but you can see that in this example the sellers, the aggressive sellers, weren't really strong, because if you compare the strong selling and compare what the delta did to the price in comparison to the other candles, this indicates that buy limits are really really strong. So then again we touch the most volume created, the POC of the lowest low candle, and create again a lower low. So in this time not many sellers want to come in on the end. So we have a min delta of minus 300 and minus 300. So they tried, but they didn't really get it. So then, as you can see, they take their defeat, their loss, and over this swing, or the latest position where you can position yourself would be over this swing, stop loss, and then your target over the top. So yeah, I don't think that you will understand this. If you want that I make a video over the footprint chart and I explain it to you, comment it, I will do it. So our next trap would be stop fishing, and stop fishing also really common. I think many of you guys know it because it's the most common trap of retail traders getting trapped. So we always have to identify a low, and then we have to look what the low indicates us. In this example, this is our buying tail and our low is down here. And you can see liquidity is fished here. And also in this example, you have two steps where you really can get in. So first of all, if you see in the order flow and some things like this that we have a bad auction quality to the downside, the probabilities are really high that we have a fake out. Or also in this example, you could always trade a buying tail retest. So if you don't close inside the buying day, so over the buying tail, you could enter yourself or position yourself long, and you always want to trade the buying tails, or the tails really, of the candles. And yeah, as I told you, from liquidity which is generated down here in this segment, and then to the upside over here. So this is your point where the liquidity is laying, and this is your point where the liquidity is laying, and then you see that we take out some liquidity, and then the move goes up, and then we take out the rest. So really stop fishing, you have to identify a zone, a wick, a low or high, and then you have really to look that the high and the low gets broken. In this example, a bit better. So we have a bad auction quality to the downside, a one-way auction we so call, and then we have a low which is created, and this low then gets broken. But which is very interesting is that the low gets broken, but in a really cheap way. So because the auction quality builds fair value gaps, the auction quality to the downside wasn't good, I will show you, I think. And then all the guys which were positioned long here, long here, and long here, and put their stop loss down here, get stopped out. All the breakout traders who go in short on the lowest low of the day, really dumb, but there are some traders who do it, also gets not filled, because they enter their position here, take profit would be down here, and there you put their stop loss over this top. So yeah, we also have to look up the swings, and as you can see, we want to go in over this swing here which was created. Also a good probability for you guys to know, if we have a range and we trade out of this range and we come back into the range, and we build a scenario like this. So this is our range top, this is our range low, and if we form our range like this, So in this scenario, we fake out the lows, we come back into the range, and then we retest the low or the high, depends if you're short or long, of the range, and then we trade over the swing again. We have an 80% probability to trade through the entire range. So also this could be a really good setup, which you can combine with your stop fishing. So your entry would be like here, your stop loss here, and your take profit, yeah, could be like here or even over the top. Depends really how you want to let the trade develop. Here on the end of the day session, the market didn't get the high, but as you can see, we opened with a really good gap. So our take profit would get filled if we have the possibility to trade overnight positions. So yeah, but in the most future prop firms, you don't have you can't really trade it. So in this example, stop fishing, how I traded it, as you can see in one of my PA Apex accounts, a really good trade. We have here our zone where the stops were laying, and then we have our next zone where the other stops of the other side are laying, so liquidity and liquidity. And as you know, we would always trade from liquidity to liquidity. And I don't know if you can see it really clearly, but I positioned myself just over the swing really that was created, and also when we got back into the range. And so yeah, stop loss and take profit risk reward ratio would be something similar to 1-to-1, but really in this example the probabilities were really high. So also what I can really recommend you is to have a chart like this. If you're interested in getting a chart which shows you really high or really low prices, you can always contact us on info@alpha-trading.de, because we're from Germany. So I would send you this email then, our templates for others. So yeah, really, you always want, first of all, to see really the pain develop under the lows or over the highs, and then you want to get in over the swing. Characteristics, I think we already explained, or I already explained everything you want to see. Always logically trade outside of the value area. So the value area is always this blue area. Value area, blue area, but always look if you can find some good trades outside of the value, because then you really know that your prices are already cheap or high. And if we then have a smart money trap, you can always position yourself, and it would be really nice. So also what you can identify, if you have a range on the top, like in this example, and you see that here the highest high was created and we had a double bottom and also a higher high, lower low, higher high fake. Always look up if we have a range on the low or the high of the day. If we really have a range and accumulated much volume, the probability isn't very high that it will be the high or the low at the end of the session. So would be a very good target, because the probability says, yeah, okay, this is a range on the top of the day. Probabilities are low that this would be still the high of the day at the end of the session. So always find some probabilities for your side and some characteristic that indicates you, okay, I can now find or search for my long trade. Yeah, okay, also trade in your bias outside. Should be clear, as I told you, outside the value. When pain is generated, look at the value and look that you always, or in the best cases, trade with the bias, okay? So logic aspect, I wrote it in German for the video that I made in Germany a couple months ago, I think. Always trade within the bias, or look that most of your positions are within the bias, because the big institutions also positions themselves with the bias. VWAP or other tools that indicates you if we are really overpriced or on the right price. So the most common price and most common volume is the VWAP. So always try to look, where are we? We want to trade to the VWAP again or from the VWAP. So yeah, look where you can really get the biggest advantage out of it. Pain, always look if you see pain in the markets. So if the if the move is really a big move that is generated in one time, so a really big short candle or really big long candle indicates pain, and how the volume is generated. Also look at the footprint chart, fundamentals, news, many moves that are generated in stop fishing or traps from higher high to lower low. Oftentimes are generated through news, because news events really take the advantage of the liquidity getting pulled out of the order books. So we don't have to really push the market down. We just can get there with really low liquidity, really low effort, and then get all the stops and then go back up. So always be aware that news and fundamentals can generate moves like this. And the last point, and the most important point, always have a good risk reward ratio and know your probabilities and your locations. So if you don't are, or if you're a POC or in the value area and don't have a good advantage with from the location, don't go in the trade, don't do the trade. If you don't have a good risk reward ratio, I would not recommend to do the trade either. So thank you very much for watching. If you have any questions regarding any of the traps, you are really pleased to comment, and I would really appreciate a thumbs up and a subscribe. So thank you very much. You can also comment alpha to show your support. I would say this was the video. Thank you very much, and we see us in the next video. Bye bye.